Welcome back. Thank you for staying with us. Now it's time for a discussion of the night. Tonight on our Money Monday segment, I want us to talk about MMF. This is money market funds. What are they, you may ask? Well, our guest tonight is a client relation manager at Centonomy Limited and a finance expert, of course, who is going to break it down for us. Again, we are talking about MMF. Welcome to studio, Stephen.
Thank you very much.
Just introduce yourself, maybe tell our viewers who you are and what we're going to talk about in depth.
All right, thank you very much for having me first. I appreciate this opportunity. My name is Stephen Waweru. I'm the Client Relations Manager at Centonomy Limited and also a financial expert. Before being the Client Relations Manager, I was in the Learning and Innovation Department. So all content that came from Centonomy Limited really passed through us before it was disseminated out to the world.
Nice.
At Centonomy, we educate people about finances and entrepreneurship, whereby we try we seek to have people shift mindset so that they can create wealth and live abundantly. One way we can create wealth is by paying ourselves first. And that paying ourselves first is by saving and investing. And today's discussion about money markets is one of the best ways in which we can pay ourselves.
Perfect. Now, as a stakeholder who is engaged in the money market, I understand you have a clear understanding of what it is. So kindly help us understand what the money market is and what a money market funds.
All right. So money market funds are one instrument that falls under an umbrella that's unit trusts, unit trust funds. So unit trusts generally are whereby different people pool resources together so that they can be invested by a fund manager and one whose day job is really to invest for people. We like to call it a sophisticated chama. At chama, we have different people with one goal coming together. They have a common goal. So someone brings his 100 shillings, the other brings 100 shillings, and together we have maybe 20,000 and we can do something with that. So money market fund is more or less something like that. But how is it different from other unit trusts, you may ask? It's different in that its investments are made to short-term securities. An example of short-term securities like treasury bills, the 91 days, the half year, and the 364 days instruments. So yeah, generally that's what a money market fund is.
Right, now maybe before we going deeper into the topic, what are the pros and cons of investing in money market funds? I understand it's also an umbrella of investment, so tell us the pros and cons.
All right, thank you for that. Great question. Pros of investing in a money market fund. Why should you invest in a money market fund? I'll try to break it down. One, why you should invest in a money market fund is guaranteed, or okay, not really guaranteed, but it is a low risk instrument, which means you don't have any big risk of not receiving back returns on what you invested. So there's capital preservation. Capital preservation in that if I invest 1,000 today, I am almost 100% sure that I will have something at the end of the year. My 1,000 won't go away, even if I won't get a lot of interest. The second thing is this interest you're speaking about is usually compounding, in that if I invest 100 shillings today at say 10%, the next time it will be 110. From there, it will go to say 121 and not 120. So we'll get 10% of whatever we already have. So it's a compounding interest. Fun fact about compounding interests, Albert Einstein himself said that it's probably the 8th wonder of the world. He who knows about it earns from it. He who doesn't, he pays it. So it's a great instrument in that. Secondly, third, these professionals manage your funds. You don't have to do research every morning to look at what company or where should I be investing or what bank is performing in what way. You just give them your money after doing your due diligence, and then of course you don't have to relax because there's nothing like passive investment. If you want to invest, you really have to really be in there, be following and know everything that's going on in that investment. Another advantage of having a money market fund is that you can easily liquidate your money. Now, typically people are advised to put their emergency funds in such funds, that's money market funds. It's a great instrument because you can liquidate your cash easily. You can, if you want to convert whatever you have invested there into cash such that you can use it, it will be easy for you to do that. Now, the cons, I'm really not going to call them cons. Let us look at them as limitations, yes, or challenges. Some of the limitations of a money market is that it's affected by fluctuating inflation rates. For example, last month the inflation rate in Kenya was 9%. And most money market funds in Kenya right now are giving an interest of between 7 to 9% or 10%. So you see, if you're gaining less than the current inflation rate, you could arguably be said to be losing money. However, that's not something that happens a lot of times. We must understand that we are in hard economic times. The economy is not doing very well. The inflation rate typically should be between 2.5 to 7.5. That's why every central bank meeting, you see them trying to raise interest rates to try and bring the inflation rate down and bring some balance to that. Maybe another limitation could be associated costs. Some instruments do have quite high costs, and especially if you factor in transaction costs. There's one good thing to that, however, if you're using M-Pesa especially, the pay bill amounts you pay for transaction have reduced, so it's maybe not as expensive as it used to be, but it's still quite something. So yeah, that's something to look out for. Yeah.
Now, Stephen, tell us how to assess the reasonability of money market funds. I was doing my research and I came across a report that says a large percentage of the pooled funds in Kenya, money market funds, they always end up invested in the Central Bank of Kenya Treasury bills. Therefore, the 91-day and 364-day Treasury bill rates offer a good benchmark of the returns one should expect. So tell us, how does this work?
Yeah, sure. So a lot of money markets, fund managers invest the funds that they've been given by the different investors in, I said, 3 instruments majorly. One is the treasury bills. Number 2, they try to negotiate with banks who are their custodians to have good rates for as a fixed income. And then there's the third one, which is commercial papers, that is short-term loans by big companies, which have the promise of course, giving them back their money. So most of this money is usually taken to the government, which makes money market funds that secure. They are among the low-risk instruments or vehicles that one could use in this country. So one of the reasons is because they go to the government. A lot of the funds are invested in governments. Now, having most of the funds invested in treasury bills, if you look at the 364-day treasury bill, the rate, if it's say 9%, the returns, reasonable returns from a firm, fund manager, should be around there, 9, 8, or at 10. Now, sometimes you will find some people who have some firms which have extra, maybe running towards 10, 11. Now, I won't say anything against that, but you should take care, because that will imply that they are investing in more risky avenues. The higher the risk, the higher the potential return, yes, but the higher the risk, the risk is high. So there's always that risk. So you should not just chase highs. You look at which money market fund has the higher ones, which is what most of us do, and then we all rush there. It doesn't always mean everything is okay. Yeah.
Somebody said to make money, you have to also make risks. So that is what you're trying to tell us, yeah?
Yeah.
So I am aware you represent a firm that deals with MMFs, but what should a potential investor look out for when choosing the right company to invest their money through MMFs, I mean?
All right. What should I, as an investor, look out for when investing in a money market fund?
Yeah.
First, of course, there's the returns. Being an investor, we are there for money. We want to make money. So you look at the returns. Now, at the returns, you don't just look at what they have this year. Look at the consistency of the returns that they have been having. For example, they've had 10% this year. Last year, they had a 9%. The previous year, they had something 8%. Now look at that and analyze and look whether it aligns with the goal of what you want to achieve. So there's the performance and the consistency. Second is regulation. Normally, there is no problem with regulation on money market funds, but this is Nairobi, nothing is impossible. You'll find someone walking around like a fund manager, and all that time they're planning to dupe Kenyans. So regulation is something else to look out for. Something else you should look out for maybe when trying to invest in a money market fund is now how quickly can you access your money? In this, I'm speaking about how many days does it typically take to convert or get cash, actual cash, in case you need it. Yeah. So normally what most money market funds do is you send an email, you say, I want to access my cash, this amount, probably for this reason, on this or from now. And then normally within 4 working days, they will have given you back. There are some which even a few hours and you'll have received your money. So that's something to look out for as well. Yeah.
Now, is it possible to invest in other countries in regard to MMF? And how can one go about it if at all it's possible?
Yeah, you can invest. However, looking at money market funds as investments that generally have a low return, you might want to do the arithmetic, do the maths, and see whether it makes sense to go invest in another country. Factor in the exchange rates, factor in all the things that it takes. For example, the management fees for different countries will differ depending on the fund manager. Sometimes there are some taxes imposed on, say, external investors who are not from within that locality. So there's that.
All right, now tell us about accessibility. How accessible is this type of investment to the common mwananchi?
Accessibility. Now, money market funds are probably the most popular investment vehicles in this country. A lot of people are investing using money market funds because one, the barriers to entry have been are limited. They have been reduced by a great deal. For example, you can invest as low as 100 shillings in some money market accounts. You can invest 2,500. There are some 4,000, 10,000. So you see, any person, a retail investor especially, who has been neglected majorly in this country. For example, as a retail investor, the NSE won't give you any significant returns. As a retail investor, you probably won't access the bond market. You won't be able to invest in treasury bills because that one you have to have 100,000. For bonds, you have to have 50,000. For infrastructure bonds, you have to have 100,000. So a lot of investors don't access such investments. However, for money market funds, you can go with as low as 100 shillings. There's also the fact that you don't need to open any accounts, which most people don't like. Telling someone that to invest in this bond, you need to go to CBK, your bank, and open a CDS account. or a CDSC account to invest in shares, it's really not something most people like. So you don't need all those to invest in a money market. You just need to email a money market, one that you have chosen upon doing your research, your due diligence, and understanding that this is what I want because of this and that reason. Now, there's also the fact that money markets, you can easily liquidate.
Okay, tell us about that.
It attracts people that they can get their money when they want. Unlike shares, when you will have to try and sell at the NSE, and it's probably not a good season for the particular share you bought, no one wants to buy it at a price that you are putting, the price that you want to sell it at. So most people will usually try to avoid that. So it sort of, money markets are now attracting people more and more. There's also after COVID. After COVID, the country received a beating economically. So a lot of instruments were not giving good returns. People ran off from the stock market. People ran now towards bonds and treasury bills, which were giving a certain security. There is the fact that the government rarely defaults. It's not never. It's rarely. So people ran towards that. Now, money markets, because they majorly invest the money in treasury bills, which are government-backed, so it's quite difficult for any default to happen. Most people ran towards the money market, so that led to a lot of people going towards the money market direction.
Now, for someone seeking to save money, what is the most effective platform between banks, bank saving accounts, and money market funds, and maybe also about SACCOs?
All right, so I will answer that question with a cliche statement. The best avenue is one that matches your goal. So when you are saving, when you are planning to invest, why are you doing it? What do you want to achieve at the end? Investing for the sake of investing is boring, and no one likes boring. You'll invest for 1 month, the second month, and by the third month, umeenda sherehe nayo, or you found something else to do with that money. So what is the goal that you want to achieve from that? Now, maybe I should say a SACCO. You've mentioned a SACCO. One advantage of investing in a SACCO is that you can get a loan based on your capital, the share capital. So you can always request, after investing for say 6 months, in most SACCOs, you can ask for a loan and get a lot of get some capital to do something else, say a business or anything that you want to do. That's one advantage of a SACCO over a money market fund. Secondly, is that through SACCOs you earn dividends from your share capital. You know, SACCOs, from those loans, when you pay, there is some interest. So the SACCO has gained some money as profit from doing business with people, giving them loans. So at the end of the day, they will have some money which will be part of the profits. They will set aside what should be what should go to dividends and distribute among the investors. So there's that. An advantage of the money market is that you can withdraw all your money if you want, but you can't do that for most SACCOs because the rules are against it. Now, to current accounts and fixed accounts, normally it's not good to have money just lying around, and putting it in that account, in a current account or a savings account, is really almost equal to letting money stay idle. And you know, even the Bible rebukes people who let money just stay idle. In the parable of the talents, there's someone who was called slothful and wicked because they didn't invest their money. So we advise people to put it in money market funds because that way you will be able to earn some interest from the money as opposed to putting it in a current account or a savings account. Now, fixed deposit accounts normally have some interest, but it's usually lower than the inflation rate, which means that at the end, all in all, you will still be, in a way, losing some money.
All right, Stephen, thank you so much for that conversation on money market funds. We have come to the end of this discussion. We'll be having further discussion still on money market funds outside this conversation, this interview, of course. We are taking a very second short break at this point. We're coming back with more, of course. Stay tuned.